Hey guys, so welcome back to the channel. Today I have another trading strategy which I'm going to backtest for you over 100 trades. I will first tell you about the indicators that we're going to be using, show you a few examples, and then perform the 100 trade backtest. This strategy involves two trading indicators, the exponential moving average and the moving average convergence divergence, also known as the MACD. So guys, if you want to support this channel and receive exclusive access to all the strategies we have backtested so far, please check out our Patreon. We will also have a Discord live chat which you can use to ask any questions to the community. The first 30 people joining the middle tier will automatically have full access to the top tier at no extra cost, allowing you to send a strategy for me to backtest. I will create a video similar to the one you're watching right now and present everyone with the results. So please consider having a look at the first link in the description, and I hope to see many of you on the Discord community. So an exponential moving average, also known as an EMA, is a sort of moving average that gives the most recent data point more weight and relevance. The exponentially weighted moving average is another name for the exponential moving average. So the exponential weighted moving average reacts more strongly to recent price movements than a simple moving average, which gives all of the observations in the period identical weight. The second indicator, the MACD, is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26 exponential moving average from the 12 period EMA. And the result of that calculation is the MACD line. A 9-day EMA of the MACD is called the signal line, and it is then plotted on top of the MACD line, which can function as a trigger for buy and sell signals. Traders usually buy the security when the MACD crosses above its signal line and sell or go short the security when the MACD crosses below the signal line. So the MACD indicators can be interpreted in several ways, but most of the time, the more common methods are crossovers, divergence, and rapid rises and falls. So this backtest is based on the 1 hour time frame on AUD USD. So here's the strategy. We go long when the price is above the EMA and the MACD crosses upwards or becomes positive, and we go short when the price closes below the EMA and the MACD crosses down, meaning it goes negative. We place the stop loss at the last swing. We don't have a maximum number of trades that we can have at any given time. We have a fixed 1-to-3 risk to reward ratio. And the final rule is when the open profit reaches 1R, we move the stop loss to break even. So essentially, once that is reached, price will either hit the stop loss at break even or hit the 1-to-3 risk to reward, take profit. So let's get on the charts now so I can show you a few trades and then we'll dive straight into the backtest. All right guys, so here we are on the charts, AUD USD on the 1 hour time frame. We'll go ahead and add the indicators. So the first indicator we're going to be adding is the exponential moving average, and the second indicator is the MACD. So the MACD is the moving average convergence divergence. So let's go ahead and change the settings. So for the EMA, settings will be a length of 200 and a method of EMA. And you can change the color if you want. I usually have it white and a thicker line, so that is quite obvious. And then the settings for the MACD will remain by default. However, in this case, we will disable the MACD and the signal lines to just keep the MACD histogram, simply because in this case, when the MACD histogram turns green, it just means that the MACD line has crossed the signal line in a bullish move. So we'll click OK right here. And so the strategy is we're looking for short positions when the price closes below the 200 EMA, and we enter a short position when the histogram turns negative, essentially when the MACD is showing bearish behavior. So in this case, you would have gone short right here. You would have either moved your stop loss right here at this level, so this would have been a loss, or you would have placed it here as a conservative side. You would have gone short again right here, placed a stop loss there. You would have probably reached your 1-to-3 risk to reward ratio. You would have gone short again right here, here. And we're looking for long positions when price closes above the 200 EMA and the MACD turns bullish. So In this case, you wouldn't have traded. And then here, when the histogram turns green right here on this candle, you would have gone long right here. You would have placed your stop loss at the last swing, and you would have aimed for 1 to 3 risk to reward ratio. So let me show you a few examples on the charts, and then we'll dive straight into the backtest. So here are a couple more examples. The price closes above the 200 EMA. The histogram turns positive. It turns green. We go long. We place the stop loss at the last swing right here, and we aim for a 1 to 3 risk to reward ratio. Similarly, it turns green again on this candle, so we go long. On the next, we place the stop loss at the last swing. If you would have gone a bit more aggressive and you would have put your stop loss right here, you would have been stopped out there. But in this case, if you would have played it a bit more conservatively, you would have placed your stop loss right here, and the maximum open profit would have reached a 1 to 1.26. So basically, you would have moved at this stage, you would have moved your stop loss to break even, and so the break even would have been hit here. Similarly, it's the same for this trade as well. Where it turned positive here, but actually it didn't reach the 1 to 3 risk to reward ratio, and therefore it just became a break-even trade. And again here, this was a successful trade right here. So let's go ahead, do the back test, check out how this strategy performs over the long run, over 100 trades, and I'll see you for the results. So there you go, guys, the backtesting results on AUD USD. We were risking 5% per trade. We had a maximum drawdown of 23% on a risk to reward ratio setting of 1 to 3. We had 20 wins, 32 losses, and 48 trades that ended up in break even, with a maximum of 3 wins in a row and a maximum of 5 losses in a row. and that gives a win rate of 39% over 98 days. So the net total profit was 80.6%. So if you would have started with $10,000, you would have ended up with $18,000 after slightly more than 3 months. It works very well on trending markets, not very well when the market is flat, but this is why we've chosen the 1 hour time frame. Let me know what you guys think. If you think this would work on other time frames, let me know in the comments, and I'll see you in the next video.